The conventional playbook for international wealth migration is broken. For decades, the standard advisory sequence for high net worth principals followed a predictable, inward-looking line of logic. Identify an attractive low-tax destination, incorporate a holding company, and sever ties with the home country. This model is fundamentally asymmetrical. In the 2026 legislative environment, failing to balance both sides of the cross-border equation, origin and destination, is no longer an administrative oversight. It is an existential risk to a family's capital base. We have entered an era where high-tax jurisdictions have evolved sophisticated, automated, and deeply intrusive mechanisms to capture wealth as it attempts to cross their borders. Surviving this exit requires shifting focus away from simple inbound convenience and committing to a comprehensive, multi-year exit blueprint. This is about precision, structural integrity, and anticipating the inevitable audit. We aren't just talking about changing your address. We are talking about uncoupling your balance sheet from a sovereign entity that views your departure as an opportunity for final tax extraction. The exit is no longer a simple legal maneuver, it is a forensic event. Canada's departure tax framework inverts the logic of traditional capital gains in ways that many advisors fail to communicate to their principals. Under Subsection 128.14 of the Income Tax Act, the moment a natural person ceases to be a Canadian tax resident, the Canada Revenue Agency deems that individual to have disposed of substantially all of their worldwide property at fair market value. This is a statutory fiction, a legal construct that ignores economic reality. There is no transaction, no liquidity event, only a valuation moment imposed by statute at the border. You have not sold the asset, you have not received cash, yet you are taxed as if the sale had occurred at the most aggressive valuation possible. The implications of this cannot be overstated. When the state imposes a deemed disposition, they are essentially taking the role of a silent partner in your business, one who demands their cut without having contributed a single dollar of capital or a single hour of operational labor. They are not interested in what you could get in a fair market negotiation. They are interested in the highest theoretical value they can justify on a spreadsheet to ensure maximum tax capture before you leave their reach. This is a predatory calculation designed to front-load your tax liability, and it forces a complete, often painful, re-evaluation of your liquidity position months before you actually file your final return. Consider the Canadian business owner who has built a private company over 15 years with an adjusted cost base near zero. This is a classic profile for the departure tax trap, a professional valuation conducted under normal commercial circumstances. With time, a motivated buyer and negotiated earnouts might attribute a value of $8 million to those shares. A departure date valuation conducted under the statutory framework of Subsection 128.14 may arrive at a figure significantly higher. Why? Because the CRA's valuation experts are mandated to assume a hypothetical buyer, regardless of whether a real buyer exists. The individual has not sold the company, yet the CRA treats the individual as having disposed of those shares at fair market value, triggering a taxable capital gain equal to half the appreciation. This valuation trap locks the principal into a tax liability calculated against a paper value that they may never actually achieve in a real-world negotiation. It effectively forces the taxpayer to borrow funds just to pay the tax on wealth they haven't actually realized, creating an artificial insolvency created entirely by statute. You are now beholden to the state for a tax bill generated by a hypothetical transaction that never actually took place. The administrative framework surrounding departure tax carries structural penalties that operate independently of the underlying tax liability. Form T1161 requires a comprehensive declaration of all property owned at departure where fair market value exceeds $25,000. This is not a casual disclosure. It is a declaration of war on your own assets. Incomplete disclosure exposes the taxpayer to CRA audits and reassessment of the entire departure tax computation, which can drag on for years. Furthermore, the departure tax deferral mechanism via Form T1244 is not unconditional, where federal tax exceeds 16,500 Canadian dollars. The CRA requires bank letters of credit or registered charges over corporate assets. This effectively makes the Canadian government a secured creditor in your international structure, conditioning every subsequent capital event on their prior consent. The most critical error principals make is treating migration as a destination-based optimization. The pre-departure window is your only period of full domestic taxpayer status. Once crossed, the deemed disposal fires and the planning window slams shut. The asset staging protocol mandates the deliberate, sequenced realization of embedded capital losses within this final period of domestic residency to absorb deemed capital gains. You must re-engineer your balance sheet while you are still fully protected under the domestic tax regime. Migrating intellectual property, resetting cost bases, and harvesting losses are not tax tricks. They are essential defensive maneuvers in a high-stakes environment where the state is actively trying to capture brand goodwill and operational networks before you go. If you wait until you are already packing your bags, you have waited too long. Australia's equivalent instrument is CGT Event I1, codified under Division 855 of the Income Tax Assessment Act 1997. On the day an individual ceases to be an Australian tax resident, CGT Event I1 triggers a compulsory deemed disposal of all assets that do not constitute taxable Australian property, forcing the capital gain into the final resident tax return. They have essentially built a net that catches everything of value as it attempts to leave the country. The Foreign Resident Capital Gains Withholding Scheme has undergone a transformation that is, in structural terms, one of the most consequential changes to the Australian transaction landscape. The $750,000 threshold has been removed entirely. The withholding obligation now applies from the first dollar of transaction value. The withholding rate has been increased to 15% of the gross purchase price. On any disposal of Australian real property or taxable Australian property classified assets by a foreign resident vendor, the purchaser must withhold 15% of the full gross consideration and remit it to the ATO at settlement. For a vendor managing a leveraged acquisition, this is not a timing inconvenience, it is an immediate and compulsory disruption to the capital event. This creates a liquidity crunch that can collapse deals if the vendor has not structured their financing to anticipate this massive sudden cash diversion. It is a blunt instrument designed to guarantee tax collection at the source, regardless of the vendor's actual tax position. The final and most technically demanding tier of an integrated exit strategy is the integration horizon. A severe error in cross-border structuring is assuming that a change in residency breaks the exit state's ability to tax legacy assets. If a principal departs Canada, establishes a holding company in a zero tax hub, and subsequently attempts to distribute accumulated corporate earnings from the old operating company, they hit the wall of Part 13 non-resident withholding tax. Under the Canadian Income Tax Act, distributions of dividends or management fees to non-residents trigger an immediate statutory withholding tax of up to 25%, because the UAE, for example, does not share a comprehensive bilateral tax treaty network with Canada that mitigates this distribution drag. A transaction designed to extract wealth tax-free to the Gulf instead surrenders a quarter of every dollar to the CRA. This is the ultimate exit failure. You successfully left, but your money is still being taxed as if you never moved. The modern parameters for wealth migration are uncompromising. Whether it is Canada's Subsection 128.14, forcing an immediate paper liquidation, or Australia's aggressive utilization of Part 1 VA to target post-departure restructures, high-tax nations have systematically re-engineered their legislation to seal the exits. Sovereign risk management is no longer an optional overlay. It is the definitive entry-level baseline for international wealth protection. Principals who successfully preserve capital in this decade are not those who execute the fastest. They are those who structure the earliest, specifically auditing how outbound exit frameworks interact with inbound distribution mechanics. This requires a forensic approach to every asset, every subsidiary, and every potential tax treaty vulnerability. You cannot afford to be reactive. The state is proactive, automated, and relentless in its pursuit of exit-based tax revenue. The principals who will successfully preserve capital in this decade are those who structure the earliest. Sovereign risk management is now the definitive entry-level baseline for international wealth protection. We are not just building structures. We are building fortresses that can withstand the inevitable legislative and fiscal scrutiny of the next decade. In episode 6, we transition to the inbound equation. We will conduct a granular architectural breakdown of the corporate holding frameworks of Hong Kong and Dubai, analyzing their specific treaty networks and mapping how to build an unassailable global platform rather than a simple tax residency change. We will move past the exit and into the architecture of the new, secure, and tax-efficient global structure you need for your family's future. See you in the next episode of Global Wealth Migration.
Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.